The date was March 7th, 2025. Gold exploded past $3,100 per ounce. Silver rocketed through $35. In just 72 hours, the precious metals market gained more value than some emerging economies produce in a year. Retail investors flooded online forums celebrating the rally. Financial media called it the vindication bulls had been waiting for. But here's what nobody wanted to say out loud. The smartest money in the room was already walking toward the exit. This is the story of the surge everyone missed, not because it didn't happen, but because most people were looking in the wrong direction while the real game was being played behind closed doors. And by the time you understand what just occurred, the landscape of global finance may have already shifted beneath your feet. Let me take you back 3 weeks before the explosion. The world looked different then. The dollar index sat comfortably above 104. Bond yields were stable. Central banks were still talking about soft landings and controlled inflation. The financial establishment had convinced itself that 2025 would be the year of normalization. Recovery. Calm waters ahead. They were wrong. Catastrophically wrong. What actually happened wasn't a sudden shift in investor sentiment. It wasn't a technical breakout that triggered algorithmic buying. What happened was a coordinated recognition that the global monetary system had crossed a threshold it could never walk back from. And gold, that ancient store of value our ancestors trusted when empires fell, was sending a signal that very few were prepared to decode. The context section begins here, and you need to understand the machinery behind this move because what looks like a rally might actually be something far more sinister. Gold doesn't move $350 in a week because traders got excited. Silver doesn't surge $12 because of industrial demand projections. These are moves born from fear, institutional fear, the kind that doesn't make headlines until it's already too late. In the first week of March, something broke in the Treasury market. Not visibly, not dramatically, but the cracks were there for anyone paying attention. Auction demand weakened. Foreign central bank holdings started declining at an accelerating rate. The Federal Reserve's balance sheet, which everyone assumed would keep shrinking, suddenly stopped contracting. Then, quietly, it started expanding again. Nobody rang a bell. Nobody sent out a press release. But the money printing presses that were supposed to be gathering dust started humming again. And this is where the story gets interesting. Because when central banks restart the printers after promising they wouldn't, when they start buying their own debt to prevent yield explosions, when foreign governments begin rotating out of dollars and into hard assets, that's not a market event. That's a confidence event. And confidence, once lost in the monetary system, doesn't come back with a few reassuring speeches and adjusted forward guidance. Global economic reactions came swift but coded. You had to know where to look. China's State Administration of Foreign Exchange released data showing their gold reserves increased for the 17th consecutive month. Russia continued accumulating despite sanctions. Poland announced an acceleration of their repatriation program, physically moving gold from London and New York back to Warsaw. India's imports of physical gold hit records that made previous years look like warm-up rounds. These weren't investment decisions. These were strategic repositioning moves by nations that saw something coming. The Bank of Japan, trapped in their own monetary prison, watched the yen weaken further as their yield curve control policy started resembling a suicide pact more than a strategy. The European Central Bank maintained their dovish stance publicly, while privately, ECB governors started asking uncomfortable questions about dollar dependency and reserve diversification. And the Federal Reserve, that institution everyone assumes has everything under control, started showing signs of stress in their own policy communications. The minutes from their meetings revealed divisions, disagreements about the path forward, uncertainty about whether they had any good options left. But let's talk about what this really means with actual data, with logic, with the cold mathematics of monetary physics. Gold rising isn't inherently bullish or bearish, it's diagnostic. It tells you what's happening in the denominator, in the currencies we measure everything against. When gold rises this aggressively across all major currency pairs simultaneously, it's not gold becoming more valuable. It's paper money becoming less trusted. Look at the numbers forensically. Gold gained roughly 16% in dollar terms during this surge, but against the yen, it gained 23%. Against the euro, 19%. Against the pound, 18%. This is a universal devaluation signal. Every major fiat currency weakened against the same ancient metal at the same time. That's not a coincidence. That's a coordinated loss of faith in the entire post-Bretton Woods experiment we've been running since 1971. Silver's move tells an even more complex story. Silver is both an industrial metal and a monetary metal. It's caught between two worlds. When silver surges alongside gold, but with higher volatility, higher percentage gains, it suggests two things are happening simultaneously. First, monetary demand is spiking as investors seek cheaper alternatives to gold that still offer inflation protection. Second, there's growing fear about supply disruptions in the industrial supply chain. Silver doesn't just reflect monetary policy. It reflects real economy concerns about production, manufacturing, and the physical world of making things. And then there's the mining economics to consider. Gold mining costs have been rising relentlessly, energy costs, labor costs, regulatory costs, declining ore grades. The all-in sustaining cost for major producers now averages somewhere between $1,300 and $1,600 per ounce. That means at current prices, mining companies are printing money. But here's the trap that most analysis misses. Those profit margins don't automatically translate into increased production. Gold mines take 7 to 10 years to develop. The easy deposits are gone. The marginal ounce gets harder and more expensive to extract every single year. So even with these prices, supply response remains constrained. Now let's talk about historical parallels, because this isn't the first time we've seen this movie. In 1979 and 1980, gold went from 200 to 850 in a parabolic surge that seemed unstoppable until it wasn't. That rally was driven by inflation panic, geopolitical chaos with the Iranian Revolution, and a Soviet invasion of Afghanistan. The dollar was dying, or so everyone thought. Then Paul Volcker raised interest rates to 20%. He broke the back of inflation, he broke the gold rally, and he broke the economy in the process. Unemployment hit double digits, but he saved the dollar's credibility. The question worth asking now is this: do we have another Volcker? And even if we did, could today's debt-saturated economy survive that medicine? In 2011, gold hit $1,900 and everyone said it was going to $5,000. It didn't. It crashed back to $1,050 by 2015. That rally was driven by quantitative easing panic after the 2008 financial crisis. Investors feared the Federal Reserve's balance sheet expansion would destroy the currency. But the Fed eventually tapered. The dollar strengthened. Emerging markets that had bet against America faced their own crises. And gold entered a bear market that lasted years. The difference between then and now? The debt. In 2011, U.S. federal debt was $14 trillion. Today it's $36 trillion and accelerating. The room for policy maneuver has shrunk dramatically. Go back further. The 1970s stagflation era, where gold rose 20-fold. That wasn't just about inflation. It was about America abandoning the gold standard completely in 1971, the collapse of confidence in government competence. After Vietnam and Watergate, oil shocks that proved how fragile the global system really was. The parallels to today are uncomfortable. Energy market instability, geopolitical fragmentation, massive government deficits, declining faith in institutions, and a monetary system running on pure confidence with nothing tangible backing it. But let me tell you what's really happening beneath the surface, because the underlying causes go much deeper than inflation fears or central bank policy mistakes. What's driving this surge is the slow-motion collapse of the petrodollar system that has underwritten American power for 50 years. Since the 1970s, oil has been priced and traded primarily in dollars. This created automatic demand for dollars from every oil-importing nation on Earth. It allowed America to run massive trade deficits without consequence because the world needed dollars to buy energy. That system is dying. Saudi Arabia is now accepting yuan for oil sales to China. Russia has completely de-dollarized its energy trade. The UAE is building non-dollar settlement systems. Every crack in the petrodollar architecture reduces global dollar demand and increases the necessity for countries to find alternative stores of value. Enter gold. Enter silver. Enter the ancient monies that don't require trust in a declining hegemon. Then there's the deficit spiral that nobody in Washington wants to acknowledge. The U.S. government is borrowing roughly $2 trillion per year just to maintain current operations. Interest on the debt now exceeds defense spending and will soon exceed Social Security. The Federal Reserve is trapped between fighting inflation with higher rates, which makes the debt unsustainable, or cutting rates to ease debt service, which reignites inflation. There is no clean exit from this trap. And markets are starting to price in the probability that the exit, when it comes, will involve significant currency debasement. The banking sector faces its own reckoning. Regional banks are sitting on massive unrealized losses in their bond portfolios. Commercial real estate is collapsing. Office vacancy rates in major cities are hitting Depression-era levels. The banking crisis everyone thought was contained after Silicon Valley Bank's failure never actually ended. It just went quiet. But the stress is still there, bubbling under the surface, waiting for the next catalyst. And when people lose faith in banks, they don't hide cash under mattresses anymore. They buy gold. Expert insights and economic logic point to something even more fundamental. The global economy is transitioning from a unipolar dollar system to a multipolar currency regime. This doesn't happen smoothly. This doesn't happen without volatility. When empires decline, when reserve currencies lose their privileged status, the transition period is characterized by exactly what we're seeing now. Extreme volatility in exchange rates, flight to hard assets, fragmentation of trade flows, the emergence of alternative payment systems. Gold and silver aren't just investments in this environment. They're geopolitical positioning tools. Central banks understand this better than retail investors. That's why their gold buying has hit records. That's why the physical market is separating from the paper market. You see, most gold trading happens in futures markets and ETFs and financial instruments that are just claims on gold, not actual metal. But central banks want physical. They want bars sitting in their vaults. Because when the system breaks, paper claims become litigation, physical gold becomes power. And here's where the trap question becomes critical. Is this rally sustainable, or are we watching the setup for the greatest bull trap in precious metals history? The bull case says we're in the early stages of a decade-long revaluation, that debt levels ensure continued monetary debasement, that geopolitical tensions will keep escalating, that the dollar's reserve status is in terminal decline, that gold could reach 5,000, even 10,000 per ounce as the system resets. The math actually supports numbers like that if you assume a return to historical gold backing of money supply. The bear case says this is a speculative mania driven by fear that will collapse when central banks restore credibility, that the dollar will strengthen as other currencies fail faster, that deflation, not inflation, is the real threat as debt destruction takes hold, that gold will crash back to 2,000 or below when reality sets in, that this rally is the last gasp of gold bugs before a brutal multi-year bear market. Both cases have merit. Both cases have historical precedent. The truth is probably somewhere in between, but with a crucial timing question. Markets can remain irrational longer than you can remain solvent. Even if the long-term trajectory is higher, even if the systemic case for gold is sound, that does not mean we can see a vicious correction that destroys leveraged positions and wipes out momentum chasers. The consequences of this move extend far beyond precious metals markets. If gold continues rising, it pressures central bank credibility. It forces them to either defend their currencies with higher rates, which breaks the economy, or capitulate and accept inflation, which breaks savings. Emerging market currencies that are already weak will face capital flight. Countries with dollar-denominated debt will face refinancing crises. The whole architecture of global finance, built on the assumption of dollar stability, starts wobbling. For everyday investors, this creates impossible choices. Hold cash and watch purchasing power erode. Buy bonds and accept negative real returns. Buy stocks at valuations that assume eternal growth in a world entering contraction. Or buy hard assets and accept volatility that most people can't psychologically handle. There are no safe choices anymore. There are only different flavors of risk. The commodity complex is already responding. Oil prices are sticky despite weak demand because producers know currency debasement is coming. Copper, that most economically sensitive metal, is sending mixed signals. Agricultural commodities are rising because food security trumps financial engineering. We're entering a world where real things matter more than financial claims, where tangible assets outperform intangible ones, where the physical economy reasserts primacy over the financial economy. What happens next depends on variables nobody can control. Will central banks blink first and start cutting rates aggressively? Will governments attempt fiscal austerity to restore confidence? Will geopolitical tensions escalate into actual conflict? Will the banking system face another acute crisis? Will China make a move on Taiwan that reshapes everything? Will there be a debt ceiling crisis in the US that triggers a technical default? Any of these could be the catalyst that either propels gold to unimaginable heights or triggers a deflationary collapse that drowns everything. The technical picture in gold is simultaneously bullish and terrifying. We've broken out of decade-long consolidation patterns. We've cleared all-time highs across multiple currencies. Momentum is extreme. Sentiment is getting frothy. Hope and interest in futures markets is at levels that historically precede corrections. But every technical indicator that says overbought has been saying that for months while price keeps climbing. This is what happens in paradigm shifts. The old rules stop working until suddenly they work again with devastating force. Silver's gold ratio, that ancient metric comparing silver price to gold price, sits around 88 to 1. Historically, it averages between 50 and 60 to 1. If that ratio reverts to mean, either gold needs to fall or silver needs to double. The ratio has been broken for so long that some analysts claim it no longer matters. But ratios that persist across millennia don't disappear because modern markets decide they're irrelevant. They reassert eventually, violently. The mining stocks present their own puzzle. Typically, when gold rises, mining stocks leverage that move 3 to 1. They're supposed to be turbocharged plays on the metal. But this rally has seen muted response from miners. They've risen, sure, but not with the explosive force you'd expect. This divergence suggests either the market doesn't believe the gold rally is sustainable, or there are operational concerns about the mining sector that aren't being widely discussed. Perhaps both. Let's address the elephant in the room. Could governments simply ban gold ownership like they did in 1933? Could they impose windfall taxes on gains? Could they restrict bullion purchases or movements? History says, yes, they could, and they have. Executive Order 61102 confiscated private gold holdings at $20.67 per ounce, and then immediately revalued gold to $35, effectively stealing 35% of private wealth. If things get desperate enough, if the system truly faces collapse, don't assume property rights will be respected. Desperate governments do desperate things. But here's what they can't confiscate: the knowledge that the current system is unsustainable. They can't confiscate the loss of faith. They can't confiscate the shift in consciousness that is happening globally as people wake up to monetary reality. The genie is out of the bottle. The awareness is spreading. The trust is broken. And this brings us to the final uncomfortable truth. This surge in gold and silver isn't primarily about investment returns. It's about survival. It's about preserving purchasing power through a transition period that could reshape the global order. It's about having something tangible when paper promises fail. The investors who understand this aren't checking prices daily or trading momentum. They're accumulating physical metal and storing it securely, viewing it as insurance against systemic failure rather than speculation for profit. The future outlook splits into several possible paths. Path 1, the rally continues, accelerates into a parabolic bubble that eventually crashes but establishes a new, much higher baseline. Path 2, we get a sharp correction here that shakes out weak hands before the real move higher begins. Path 3, this is the top, and we're about to enter a multi-year bear market in precious metals as deflation takes hold. Path 4, the most chaotic. Volatility so extreme that price discovery breaks completely and physical metal separates from paper markets entirely, trading at massive premiums. Which path we take depends on decisions being made right now in the highest levels of government and finance. Decisions about how much pain they're willing to inflict to defend the currency. Decisions about whether to save the bond market or save the dollar. Decisions about whether to risk depression to kill inflation. These aren't technical questions. These are political and social questions with no right answers. What we know for certain is this: the move we just witnessed wasn't random. It wasn't technical noise. It was a warning shot across the bow of the global monetary system. Gold and silver are screaming that something is profoundly wrong. Whether you choose to listen, whether you choose to act, whether you choose to prepare, that's your decision. But you can't say you weren't warned. This isn't just a market correction. This is a warning. The question is, who's paying attention? Because the investors who survive what's coming won't be the ones who followed the crowd. They won't be the ones who trusted the reassurances of the same institutions that missed every major crisis. They'll be the ones who read the signals, understood the stakes, and positioned accordingly. If you found value in this analysis, if this opened your eyes to dynamics the mainstream won't discuss, make sure you subscribe. Hit that notification bell. Because the story we're watching unfold is just beginning. The next chapters will be written in the weeks and months ahead, and you'll want to understand what's really happening while there's still time to respond. The surge everyone missed wasn't the rally itself. It was the signal behind the rally, and that signal is still broadcasting. The question is whether you're tuned to the right frequency.